This is Brent with Black Lion Capital Management and the U.S. Natural Gas Report for Thursday, February 11, 2016, featuring Update Analytics, incorporating data from the Update Energy Feed, Baker Hughes, and CME Group NYMEX. We'll break the report down according to the 5 regions tracked by the Energy Information Administration, starting left to right with the Pacific region, then Mountain, Midwest, Eastern, South Central, and we'll cover the overall lower 48 United States. Highlights from this week's report: a 70 billion cubic foot drawdown. The Midwest, South Central, and lower 48 regions all recorded record surpluses. We're at an all-time record low U.S. rig count, and the negative trend in natural gas continues. Let's go to the charts. Beginning with the Pacific region, all the charts are constructed the same. In the top pane, the heavy blue line is the natural gas and storage for this week. The black dashed line is the 5-year average of natural gas and storage. The light green dashed line is the 5-year average maximum, and the light red dashed line is the 5-year average minimum. In the center pane, we take the weekly change in natural gas, and in the bottom pane, we take the delta between the gas and storage and the 5-year average and report that as either a surplus or a deficit. So beginning here with the Pacific region, 258 BCF in storage, well above the 236 BCF 5-year average and slightly below the 275 BCF 5-year average maximum. In the center pane, we had a 13 BCF drawdown and a 22 BCF surplus in the Pacific region. Additionally, we'll cover the delivery points for natural gas in the various regions. In the Pacific region, we'll take a look at PG&E on the left and SoCal basis on the right. You can see both of them have widening or are moving toward discounts. In the PG&E, we started the year over 45 cents, and we're down to a dime. On the SoCal basis, the basis is widened to a minus 11 cents. In the Mountain region, 159 BCF, so right in between the 5-year average maximum and the 5-year average, following a 5 BCF drawdown, relatively stable at an 8 BCF surplus in the Mountain region. 2 delivery locations in the Mountain region, both of them trading at wide discounts. Over to the Midwest region, 739 BCF, which is actually just slightly above the 5-year average maximum, and we mentioned this at the top of the hour. We've got a 28 BCF drawdown in the Midwest, and you can see in the bottom the portion that we discussed is 150 BCF surplus. That's a new record for the past year for the Midwest region. In the delivery points, both are trading at premiums, but the premiums are being compressed since the start of the year. In the Eastern region, 620 BCF, just slightly below the 5-year average of 645 following a 21 BCF drawdown, and we're up to a 96 BCF surplus, and although that's up for the week, that's not a new record in the East. The delivery points in the East, 2 out of the 3 are both trading at discounts, and the one that has been trading at a premium started the year at $2.50, is now less than right at 25 cents and moving toward a discount. So across almost all of these regions, what we see in these basis differentials is that there is no concern in the pricing that there'll be any kind of restriction on the supply of natural gas, even during this cold time of the year. South Central region, which includes Texas and Oklahoma, so a very large producing region, still well above 1 trillion cubic feet. Very interesting to note here. This is the February 5th report from EIA, so this is pretty much dead of winter for the lower 48 United States, and there was no gas drawn out of the South Central region. So this is another region we mentioned at the top of the report. You can see in the bottom there a 267 BCF surplus. So we are approaching a 20% surplus in the South Central region. Looking at the 4 delivery points in the South Central region, that surplus of gas is reflected as all of them are trading at deep discount. Lower 48 United States, you can see in the center pane here the 70 BCF drawdown for the nation, and the natural gas and storage, 2.86 trillion cubic feet, just slightly above the 5-year average maximum. And we mentioned at the top of the report for this area also that for the lower 48, this is a record surplus for the last year of 543 BCF. Exploration and production activity will represent that by the Baker Hughes rig count. This is the North American rig count, so this includes U.S. and Canada, and rigs exploring for oil and natural gas. Down to 543 in the report last Friday. I've taken the brown horizontal line or horizontal dash line here, goes all the way back and doesn't intersect until August of 1999. So this is a new low for the 21st century. Rotary rigs in the United States exploring for natural gas printed 104 last Friday. Astronomically low. The last time the red dash line there represents going all the way back to 1992. Every week as this number decreases, it's a new all-time low for this record data set. And pricing, as you can well imagine, that's reflecting poorly. First thing we'll take a look at here is the seasonality. This is a time of year where seasonality is really rather nondescript, and it ends up weakening here toward the end of February before we get into the summer injection season. So no help is expected from seasonality. Over to the daily cloud chart. This is data from eSignal. So this is the Henry Hub natural gas futures continuous contract. This is not roll adjusted. Some things that we look at on these cloud charts here. We do have the price moving below the cloud span again. The lagging line is well below the cloud span. The turning line below the standard line, and the cloud spans are positive, but for the majority of things that we'll look at on this chart, this is still a downtrend, and it is reasserting itself by having both the lagging line and the price below the cloud spans. 60-minute point and figure chart. This is the same data we just looked at. You can see that similar to what we saw in that cloud chart, we did have this breakout violate the bearish resistance line with a new signal above the bearish resistance line, and it's quickly rolled over and now trading below this bullish support line. Once the day closes, we'll be looking for a signal below this line, and the downtrend will continue on the 60-minute point and figure chart. Two targets to be aware of: an active upside target to $2.30 and an active downside target to $1.80. But the daily trend and then is negative, and we are now looking at the 60-minute trend reversing down negative. Over to the actual futures. This is a 15-minute on close chart. And this is the March Henry Hub natural gas futures NGH6 or NGH16. This morning when the report printed, we were right here around $2 or $2.05, and it gapped pretty much straight down. That's not shocking considering that's the first week of February and we only withdrew 70 billion cubic feet of gas. The forward curve for natural gas, this data from the updated energy feed also. You can see that even still down here that typically in the springtime the curve slopes down. This has gone into a very deep depressed portion of the curve. And if you go back 5 days ago, that we are down at all delivery points. So the expectation of the market is it will continue to be well supplied with gas. A little surprising given the all-time record low rig counts. This is your U.S. Natural Gas Report from Black Lion Capital Management for Thursday, February 11th, 2016. Thank you very much for joining us. If you have questions or comments, please email me directly. If you have questions or comments about Update Analytics or the Update Energy feed, please reach out to their sales team. Thank you and have a good weekend.